Well, it seems the situation just gets worse for the U.S. banking sector. This time, it is San Francisco-based bank First Republic. Its shares tanked after admitting customers withdrew some $100 billion in the month of March alone. This marks the third mid-sized bank in the United States to collapse on the heels of Silicon Valley Bank as well as U.S. lender Signature Bank. So, what happened? Well, at this point, it is a familiar refrain. Many U.S. banks and other banks around the world have been significantly raising their interest rates in hopes of putting the brakes on inflation. However, that move has been hurting investments of the bonds they purchased when interest rates were much lower. Now, here's where it gets sticky for banks like First Republic. It caters to wealthy customers. Now, that's a problem because the U.S. government or the FDIC only insures customers' money up to $250,000. So the wealthy investors saw the writing on the wall and began pulling their money out. The move caused First Republic stock to plunge 90%. And it's not just the United States. Swiss banking giant Credit Suisse has been trying to stay afloat for years and was prepared to borrow $54 billion to do just that. However, its rival UBS swooped in and purchased that bank, saving it for the time being. Right now, the U.S. government is huddling with about half a dozen major U.S. banks, trying to figure out a way forward with First Republic. The best case scenario is to have one of the major banks purchase First Republic, but they must first determine the value of that bank. And then hopefully that move will placate customers as well as financial markets, at least for the time being. Sean Caleb, CGTN in Washington.